Well, good morning, ladies. We're going to have a look at perfect competition this morning. We did look at it in the last narrated PowerPoint, but having listened to it back, I felt I was a little bit confused. So I've refreshed some of the slides, and also I'm just going to go back over some of the bits and pieces that we covered previously, just to make sure that it's all clear, because it's quite an important concept to get your heads around. Okay, so we're going to start with the 6 conditions and characteristics of perfect competition. Remember, we talked about market structure previously, and perfect competition is one that you will need to understand. Okay, so just touch on the 6 characteristics again, and just to make sure that you're clear on them. So the first one is there are many buyers and many sellers in the market, and because there are so many buyers and so many sellers, and as we'll see in a minute, they have relatively similar products. No seller in the market is large enough to influence price. So the market price is the price that the market suggests that it will be, and there is no opportunity to influence it. The second condition or characteristic of a perfectly competitive market is buyers and sellers possess perfect knowledge, know exactly what's going on in the market, and they know the prices and costs of production, and they have the access to the same technologies as well. Again, in a perfectly competitive market, consumers can buy as much as they wish to purchase, and firms can sell as much as they wish to supply at the ruling market price, which is set in the market as a whole. Okay, so consumers can buy as much as they want to, firms can produce as much as they want to at that ruling market price. There is freedom to entry and exit from the industry. That means there are low barriers to entry, so it's not very expensive to set up and move into that market, and it's also not very expensive to remove yourself from that market. So that gives freedom to entry and exit to and from the market. And all firms in a perfectly competitive market produce exactly the same product, identical products. They're homogeneous. And no transport costs are considered either. So effectively, you've got some very specific assumptions or characteristics that a perfectly competitive market will have. Now, clearly, we've talked about this before, and if you think about in a real life market, there are some instances here where it would be virtually impossible for this perfectly competitive market to exist, but nonetheless, it's still an important theoretical concept that you need to understand. Okay, some examples of homogeneous products. We looked at these previously, so I'm not going to dwell on those for too long, but where you've got very similar products, very standardized products, there are some examples there, ranging from cement to bars in Spanish resorts. And it'd be nice to think that we might be able to visit some of those soon, but of course only when you're over 18. So implications of perfect competition then. The first one is that all firms in perfectly competitive markets are price takers. They have no influence on price. The market fixes the price, and the firms within those perfectly competitive markets are price takers. They have to take the price that is sort of dictated to them by the market. And if we think about the reasons for that, firms are generally going to be quite small. They're going to sell the same product, and they have to accept the going market rate, which is determined by the forces of supply and demand in the industry. The other thing, and this is one that is a bit of a weird one, that firms are all able to sell as much as they wish at the ruling market price. Now, you'd like to think that that might happen in real world markets, but believe me, having worked in real life markets, that is not actually always the case. And as a result of this, because we've got the market rate, it stays the same basically. So the average revenue, the demand curve, and the marginal revenue line will all be the same. They're all represented by a horizontal line. Okay, so remember, average revenue is the number of the amount of sales divided by the amount of units sold, and basically your marginal revenue line is the revenue that you achieve by producing an extra unit. Well, effectively, because average revenue is the same as the marginal revenue, you can understand why that becomes a horizontal line. And the fact that we can sell as much as we want to at that ruling market price, again, that would suggest that demand is consistent. So when we look at profit maximisation, so we talked about perfect competition. Well, what we want to do now is talk a little bit more about profit maximisation, and it's something we have touched on. And fundamentally, in perfectly competitive markets, if we look at the chart that we've brought into the slide here, effectively we've got our marginal revenue, average revenue, and demand line as a horizontal line because it's a perfectly competitive market. And then basically we've then drawn in our marginal revenue, sorry, not marginal revenue, marginal cost line, which again, to start with, is at a relatively high point. It falls as we gain from economies of scale and fixed costs being spread over a greater quantity of output. And then we gradually start to increase our price as a result of diseconomies of scale over time, and the marginal cost starts to rise. Okay, now effectively, again, bearing in mind what we've said, if we're a profit maximizing company or business, then basically we will keep producing to the point at which output so we'll produce as many units as we can, and we will keep selling them for as long as marginal revenue is higher than marginal cost, because if that is the case, for every extra item we produce, we are going to be making an amount of profit. Okay, now the point at which marginal revenue equals marginal cost is the point at which a profit maximizing firm would choose to produce at. Okay, and you can understand that because effectively as soon as marginal cost becomes higher than marginal revenue, then you start to lose money on each extra sale that you make. So the profit maximizing rule is very much the condition is, and you need to be able to illustrate this in your diagrams. The point at which marginal revenue equals marginal cost is the point at which profit maximizing firms would be operating. Now that effectively means that put it in a slightly different way. So marginal cost equaling marginal revenue means that a firm's profits are at its greatest point when the addition to sales revenue received from the last unit sold, the marginal revenue equals exactly the addition to total cost incurred from the production of the last unit. Okay, so for all the time that marginal revenue is higher than marginal cost, we are making even. It might just be a tiny profit, it might be a couple of pence profit, but fundamentally, as long as marginal revenue is higher than marginal cost, that if we're a profit maximizer, we'll keep squeezing that out until the very last point at which marginal cost equals marginal revenue. And clearly, if you think about this, as long as marginal revenue is greater than marginal cost, profits will rise when output increases. And a profit maximizing firm will choose to continue to produce until the point at which their marginal revenue and marginal costs are the same. And that's illustrated quite nicely in the diagram there, okay, and also explained. Okay, only when marginal revenue equals marginal cost of profit is maximized. So at the point when marginal revenue is lower than marginal cost, profit will rise when output reduces. And when marginal revenue is higher than marginal cost, then profits will rise when output increases. So let's take a look at this then, and we did touch on this last time round, but we'll just run through it again, where we're talking about short run. So this is illustrating short run profit maximization in a perfectly competitive market, and we've shown we will show both the market and the firm's diagram to demonstrate the point. Okay, so in this instance, remember, whenever we're drawing in supply and demand diagrams, we need to make sure that we're including obviously putting our axes in, and also making sure we're labeling them and labeling the equilibrium point too. Okay, so fundamentally, when we're talking about market, we're plotting price against quantity, and when we're talking about the firm's situation, we've got costs and revenue again divided by, or not divided by, drawn up against output. Okay, so basically, if we draw in our demand curve for the market, then obviously it's downward sloping. We know that from the conversations we've had previously. As price falls, demand increases. And we've got an upward sloping supply curve where, again, where price is higher and the selling price is higher, then suppliers are more likely to want to move into the market and will provide more as a result. If we then take our equilibrium price within the market, now you can see P is drawn in there, and fundamentally, because we're in a perfectly competitive market, that is going to be a horizontal line. So that's going to be our marginal revenue and average revenue. And so our quantity of equilibrium, our output equilibrium, is drawn in at QE for the whole of the market. Okay, when we look at the firm then, okay, we've got a firm in a perfectly competitive market. We've said that our marginal revenue equals our average revenue, and that also equals our demand curve. And when we draw in our marginal cost curve, we can see that there is a point at which we've got the quantity at profit maximisation. Okay, so that's the point at which we get marginal cost equaling marginal revenue. And as we can see in this situation, although that shows the position at which we would produce the quantity of output that we would produce, we can't actually identify whether we've made a profit or loss here because we haven't got in our average cost curve at this stage. Okay, so at this stage, clearly, as we said before, the firm is a price taker, so it has no influence on the price that it can charge in the market. Okay, so on one hand, we've got the overall market position, and then we've got the firm's position as far as the short-run profit maximisation point in perfectly competitive markets. Let's take a look at in a little bit more detail at profit maximisation and how we might go about profit maximisation. Okay, now this is again a little bit more of a summary on where we were previously and when we talked about this, but traditional economic theory does assume that owners and entrepreneurs have only one business objective. So the majority of economic theory is based on the assumption that all businesses are attempting to produce a level of output at which their profit is maximised. Now, we've seen, obviously, from the conversations that we've had previously, there are other objectives that firms might set, but as a general rule, we will assume that we are in a profit maximisation position. And anyway, for whatever business objective that the firms have, these are some of the principles we need to bear in mind. Okay, our total profit is always going to equal total profit. Total profit is going to equal total revenue, take away total cost. And in that scenario, if we're talking about profit maximisation, the firm is going to produce at a level of output at which its total revenue, take away its total cost, is maximised. And that doesn't really matter what market structure the firm produces in and where it sells its output. Fundamentally, that is still going to be the same. The level of output is going to be where the total revenue is at its highest point and the total cost is at its minimum point. Okay, so the difference between the total revenue line and the total cost line is obviously the maximum point is where those two lines are the furthest away from one another, if that makes sense. And we'll see what I mean when we come to start drawing in these and illustrating this situation. Okay, so let's think about demand curve and revenue curves then. Okay, let's think about where we start to consider this and when we start to look at the way in which we can look at demand curves and revenue curves. So why would a firm not charge a higher price? Well, basically, in this scenario, if we've got a situation where we're perfectly competitive, then why would we look to try to change the price? Okay, because if we did, we tried to charge a higher price and every other firm was charging the same price, what we're going to do is lose demand for our products. Okay, so clearly there would be no incentive for us to do that. We'd basically lose, or in a perfectly competitive market, we would lose all of our sales. And clearly, the other reason why would we not want to charge at a point lower than that? Well, we've already been told within a perfectly competitive market, we can sell all of our output at the going market rate. So again, what would be the point of changing that? There would be absolutely no point in doing that whatsoever. So that's part of the reason why in perfectly competitive markets, well, you couldn't charge a higher price because you lose all your demand. You wouldn't sell anything at all, because every other buyer would be every other buyer could go to other sellers who are selling exactly the same product as you are, and at a lower price. And again, if we can sell all of our output irrespective of how much we produce, then we'd be a bit daft to be selling at a lower price, wouldn't we? And clearly, in this situation, because we're too small to influence market price, if we were a very big player and we wanted to gain market share, we could do that, and maybe try to gain some market power. However, in this scenario, we've said that there are lots of small buyers, lots of small sellers that aren't big enough to be able to influence the market price, and so all that would happen if they tried to charge lower prices, they'd make a loss. Okay, some hints to help you draw some diagrams then. One of the things that we are going to be doing over the course of the next couple of sessions is drawing quite a few diagrams. Now, one of the things that's really important is to make it easy to demonstrate or illustrate the points you're trying to make. Now, we have touched on this previously before, but I just want to re-emphasize this. It's really important to make it easier for you, so that you can then demonstrate a clear difference between equilibrium points. Okay, so this may not be particularly fresh, but it's worth reinforcing. Okay, so if ever you are providing an illustrative diagram of supply and demand, then very important that we show if there are any shifts in curves, make sure that the shifts are a sizable difference between each one of them. So you can identify the before and after, and try to make sure that if you're drawing a shift in supply and a shift in demand, make them significantly different from one another, to be able to demonstrate the before and after. And whenever you're drawing your AC curves, make sure they've got fairly steep sides, and your marginal cost curve to be relatively flat. So again, you can see there is a significant difference in what you're illustrating, and it makes it easier for you to then explain, and it's easier and more clear to see significant changes in profit and losses given any change in price. Okay, so just a bit of a hint or a tip to make sure that all helps you to complete this whole process. Let's take a look then so we looked at page 19 previously, where we looked at short-run profit maximizing, equilibrium in perfect competition. And if you need any reference to this, in addition to your course companion, on page 130 of PAL's 4th edition, there are examples of these diagrams, plus also some explanation. Okay, so we're going to move on and start to look at page 20 now, where we're looking at supernormal profits or abnormal profits in the short run in perfectly competitive markets. Okay, so we talked about, and we've showed the point at which we would be operating where marginal revenue equals marginal cost. But what we're going to do now is show, in this situation, if we were attempting to profit maximize, where would we be performing? Let's take a look at this. And again, we're showing both industry and a firm's position. And fundamentally, what we're doing is looking at the difference between average revenue and average cost here. So essentially, in this situation, obviously, we want to try and make sure that our average revenue is higher than our average cost. So again, drawing in our diagrams, and making sure that we label them and make sure we label our axes consistently. I'm going to move my Visog over there a bit so you can see it more clearly. And so again, same principle again. Remember, perfectly competitive markets. So in this case, we're going to draw in our demand curve and our supply curve. We're going to draw in our price equilibrium. This is for the whole industry, and our quantity at equilibrium. Okay, now we're going to draw in the firm's position, where we're trying to achieve supernormal profits. Okay, so again, remember, in a perfectly competitive market, marginal revenue equals average revenue equals our demand curve, because we know we can sell all that we want to at the market ruling price. Again, we've got our marginal cost curve drawn in, and you can see that the point at which marginal cost and marginal revenue are equal is our quantity at profit maximisation. That is the quantity that we would produce at as far as profit maximisation is concerned. Now what we're going to do is draw in our average cost curve. Okay, so we can see our average cost curve, which we've drawn in there, and you can see in this situation that there is a significant difference between our average cost and our marginal cost, and also obviously crosses at a different point for our marginal revenue. So the point at which our average costs are at the lowest point, okay, so thinking about, let's take that away a minute and then let's just go, whoops-a-daisy, wrong one. We can see here that fundamentally our marginal revenue and our average revenue is our horizontal line, and we can see that at profit maximisation, our point of profit maximisation, we have got our average cost line crossing at this point here. So at that point, our average cost at profit maximisation is the point at which average cost and our quantity at profit maximisation meet. So you can see that our average revenue in this scenario is at the point that equals our price. Okay, so that's our average revenue, that's our average cost. Clearly, the difference between those, so if we draw in W, X, Y, and Z, which basically shows the box that is going to essentially represent supernormal profits. Okay, so you can see in this situation, our rectangle, the green, is basically showing the difference between our average revenue, which is our marginal revenue and average revenue line, and our average cost line at the point of profit maximisation. Okay, so at this point here, our W, X, Y, and Z rectangle is basically demonstrating that we are making a profit. So in this situation, again, thinking about what we would say about this, because we've actually achieved supernormal profits, and basically anywhere where our average revenue is higher than our average cost means that we are making supernormal profits. Okay, well, in that situation, in a perfectly competitive market, because there's no barriers to entry, firms would seek to enter that industry basically because there are low or no barriers to entry. And clearly, if there's this profit to be had, then other businesses are going to think, I'd like a bit of that. And so they're likely to move into that market, okay? But that's demonstrating the point at which average cost, which essentially is your total cost divided by the units produced, and your average revenue is your total revenue divided by the number of sales that you've achieved, is the point at which at profit maximisation, that point is where the average cost is the furthest distance away from our average revenue and our marginal revenue. Okay, so hopefully that makes some sense. Again, what I would suggest, guys, is you can obviously stop this at any point, and if you will have the original PowerPoint, so you can actually build this up step by step if you want to, by effectively, let me just show you again. So we can take the information out step by step and then build it up like so. So obviously we've got that point there. We can then draw in our average cost curve, draw in our average cost at profit maximisation point, and then draw in and label our average revenue point, and then effectively draw in the point at which we are making supernormal profits over and above normal profits, and we'll come back to what normal profits means shortly, but that hopefully makes some sense to you. Okay, so that's the first. So on page 20, I'll spend a bit of time just making sure that you actually go through the process of drawing those in, and again, double check in PAL if you want to just double check the accuracy of your drawings, okay, and your diagram. We've mentioned on just halfway up page 20 that there's three possibilities for firms in perfectly competitive markets. Okay, so how much profit would a firm make in the short run? And we've said that this is the first example, okay? So supernormal profits in the short run in perfectly competition. That's perfect. That's basically the first diagram. I think what we'll do is cover subnormal and normal profit, and then we'll stop because this is quite a labour-intensive process to go through. So I need to give you some time to make sure that you've completed that and you're happy with it. Okay, let's take a look at subnormal profits or losses in the short run then in the same scenario in perfectly competitive markets. So similar sort of principle. In this case, average revenue is going to be lower than average cost. Okay, so in this situation, similar sort of scenario, we've got axes being labelled. We've got our industry example where effectively we've got supply and demand at equilibrium. Our price is at equilibrium and our quantity is QE at equilibrium. When we're talking about the firm, again, same principle. We're in perfectly competitive market, so our marginal revenue equals our average revenue, which equals demand. So we've got that horizontal line in there dictating where our average revenue will be. Now in this situation, we've got a marginal cost in a slightly different position from the previous one, but again, make sure that when you're drawing these things in, these things can vary. It's just making sure that you are demonstrating the points that we're going to explain in a minute, okay? So marginal revenue and then marginal cost. So our profit maximisation point would be at QPM. However, in this scenario, we can see that our average cost curve is higher than our average revenue curve. And so it doesn't take a rocket scientist to see that if that's what where our marginal revenue is, our average and our average revenue is significantly lower than our average cost, we are clearly into making a subnormal profit, or another way of putting it is a loss. So we can see that our quantity at profit maximisation, at that point, you can see that our average cost is significantly higher than our average revenue. And we can see that our average cost at profit maximisation is at that point there. Now, clearly, our average revenue is at a significantly lower point. And so in this case, our WXYZ box, which is in red, is demonstrating that we basically are not achieving any profit at all. In fact, our average costs are higher than our average revenue, and so at that point, even at profit maximisation, where our average cost is higher than our average revenue, well, clearly we're not making any profit at all. So in that situation, if that was what we considered to be our point of our quantity, our output at profit maximisation was at that point, and we were not able to produce at a point where our average costs were lower than our average revenue, then firms would seek to leave the industry, and it would be possible for them to do that, because in perfectly competitive situations, then the firms could leave that industry without any sort of major penalties, because there's low or very few barriers to entry, or and in this case to exit. Okay, so that's subnormal profits and losses in the short run in a perfectly competitive environment. Let's take a look at normal profits then, which is sometimes known as break-even in the short run. Okay, now we've talked about this definition when we looked in CC4 at normal profits and what normal profits means, and we know that the accountants feel that normal profits and the way in which you calculate profit in an accountant's head is very different from the way we do so in an economist's head. However, again, it's a term that we need to be familiar with. So in this situation, we are looking at normal profits or break even in the short run in a perfectly competitive market. So here, basically, our average revenue is going to equal our average cost. So to demonstrate that, again, we can go through the process of showing it on an industry basis. Okay, and our industry is not going to change a great deal. Again, we've got the same principle of supply and demand, equilibrium point, quantity, equilibrium, and our price at equilibrium labelled on our axes. Let's take a look then at this situation for the firm. So again, same principle. Our marginal revenue equals our average revenue, which equals our demand. Got our marginal cost line in there, so we can see that at that point there, we've got our quantity that we would produce at if we were profit maximizing. That's the point at which marginal revenue equals marginal cost. And in this situation, our average cost is actually at its lowest point is actually at the point at which average revenue is too. Okay, so effectively at that point there, we're not making any profits at all. As such, we're making normal profits, which is our break-even point, at which the point at which marginal revenue and average revenue, more importantly, are equal to average cost. Okay, so marginal revenue is equal to average revenue. It's not equal to average cost, but in this scenario, we have a point at which our average cost equals our average revenue. And we can see in this situation that our average revenue equals our price and our average cost at profit maximization. So at this point in the short run, in a perfectly competitive market, that would be the point at which we would be achieving normal profits. Okay, so in that situation, clearly the argument would be that the market would be in equilibrium. So firms don't mind between this activity and they're indifferent about it between this activity and the next best alternative, because they are able to carry on. They're not losing money. They're not making a great deal of money either, although they are. If you remember, when we calculate normal profits, we allow for the opportunity cost in addition to the actual costs that are included. Okay, so I think I'm going to stop there. That gives you sort of quite a bit of time and quite a bit of stuff to include in your deliberations for the next lesson. And then we will move on to look at the next lesson, long run profit maximization, equilibrium points in perfectly competitive markets. Okay, so we've looked at the short run. We're going to move on and take a look at the long run next time round. Okay, so thanks for listening. Again, I would say, guys, if this is something that's not very clear to you, we will revisit this when we start face-to-face lessons again, because it's quite important that you get to understand this, and you'll get plenty of practice anyway. Okay, thank you very much, and I'll talk to you soon.